And that wraps up a wild week here for the markets. Again, at least for the day, all three of the major averages ending in the red. You can see right there on your screen, right around the lows of the day. Dow off 392 points. S&P off just over 2%. The NASDAQ, look at that, the worst performer of the three, off just over 3%. All 11 of the S&P sectors closing in the red today. Biggest losses, consumer discretionary, energy, and materials. All right, well, let's bring in Melissa Brown, Qontigo Managing Director of Applied Research. And we also have Sylvia Jablonski, Defiance ETFs CEO and CIO. Sylvia, let me start with you just in terms of the wild action that we saw this week, this back and forth. You don't have to look any further than yesterday's action after we got that hot inflation print. Initially, we sold off, and then the stock and the markets actually spiked. What do you make of the action that we saw?
Hi, Shana. Great to see you. I think that this is all sort of par for the course in terms of what we're seeing in the market. So, there's just too much uncertainty right now. So this range-bound volatility, whether it's, quick pullbacks that are feel pretty meaningful and impactful, or quick pops that feel pretty meaningful and impactful, I think that the market just doesn't have any kind of steady footing here. And really, it's the same old story. We have all three indices in bear market territory. Inflation is sticking around a little bit longer than we would have liked it to. And that means that, the Fed and us waiting to hear the news of every rate hike is going to stick around longer than we wanted to. And I think that, until we sort of get some confidence that, the Fed is either going to sort of pause for some period of time, or that we see inflation, trending downward for a series of reads, I think that we'll kind of see this range-bound volatility for the next few months.
Yeah, of course, don't hold your breath for a pause at this moment. And Melissa, you say investors are likely to react strongly to bad news, potentially ignore or downplay good news. How in the world then do you explain yesterday S&P snaps a 6-day losing streak on the heels of a bad CPI print?
It is a difficult move to explain. I think, we were looking at, not relatively low trading volume. And I think it's just that investors they're getting sick of being negative. They're getting sick of being bearish. And so, perhaps yesterday they just decided to say, okay, well, the market's down a lot already. Let's come in. But then, today they got punished for that. So, tomorrow or Monday, will that happen again? It's hard to say. But with that negative sentiment, again, I would expect that bad news to lead to much bigger downturns than good news will lead to upturns.
So then, Sylvia, in terms of the outlook then, obviously the Fed is not going to be taking its foot off the pedal anytime soon. Where do you see the opportunities in this sort of environment, knowing that volatility is going to persist until we get the Fed to pivot at some point?
Yeah, I think it's important to think about, which investor we're kind of talking to and what his or her strategy is. So if you're a longer term investor, and I'm going to say, 3 years is sort of the bottom line there, and you plan to hold even beyond that, then, a consistent strategy of dollar cost averaging into your favorite quality stocks that have gone, from 22 to 15 multiples, but probably it's a wider span than that, and are down, to the tune of 20 to 50%, maybe even a wider span of that. I mean, this is a great opportunity for that. Could the market move on you, in reverse another 5%? It could, but over the long run, I don't think it's going to matter because, we've all been talking about this for quite some time, but since the 1950s, kind of a year out after all of this mess, you tend to see those double-digit returns. So long-term dollar cost averaging, great opportunity for that. In the short term, though, I think you have to be positioned in a different way. I think it's, if we're talking about getting through to year end, you're probably better off holding, some of the biotech and healthcare names, some of the names that are holding up. Merck is one of the few stocks that has double-digit returns this year. They pay a nice dividend. United Healthcare, some of these names are not really impacted by recession. The aging population is continuing to increase. So there's just a good story there in terms of just, safety and overall diversification. And if you're like a super short-term trader, I mean, there are bear funds out there. You can kind of short the blockchain crypto ecosystem. You can kind of, short some of the tech and semiconductor names in the short term. But that's sort of, I would say for a buyer or an investor that's a little more on the professional side. So long-term dollar cost average, just your quality companies, your Apple, Amazon, Google's, semiconductors, the 5G trade, things like that'll play out over time. In the short term, maybe stick to defensive names like the healthcare names or the alternative energy space too is a good one, hydrogen, solar, things like that.
Melissa, what do you make of earnings season so far? Because we certainly have started to get the ball rolling here. We had a number of banks report this morning. Pepsi earlier this week, actually much better than what the street had been anticipating. Is this a sign that maybe earnings season isn't going to be as bad as we had initially feared?
Well, I don't think you can use, one or two good earnings reports as a sign for what's going to happen for the entire quarter. But it certainly is better to start off the quarter with better news than it is if, we were already in the hole because of some really bad earnings reports. The impact of inflation, you were talking about the dollar before, but, we also have the impact of inflation on both the top line and profit margins that I think we're going to get a lot more clarity on what that impact is over the next couple of weeks. But certainly it's hard to imagine we're going to see a positive impact from inflation across the board.
And Sylvia, to touch on the same thing on earnings, is there anything you learned today from the earnings, the big banks, or that you expect to learn next week when we get a glimpse at Goldman and Bank of America?
Yeah, I mean, I would agree with those previous comments. A couple of good reports does not make a good earnings season just yet. It's a great start. What I would say is that I took some solace in kind of, digging into the conversations behind the earnings releases today. And one thing that kind of feels good in terms of worrying about, will we have a deep recession? We may have a recession, we may have a light recession, but when you think about the banks, it's clear that they are, well capitalized, that you're not in that 2008 financial crisis sort of state of the world. And companies like Pepsi, even CarMax and Micron, like some of the companies that have, guided lower, come out with poor forecasts, they still have great balance sheets. They still have, decent revenues. They're falling, but they're decent. So I think what I take from this is that, perhaps the bottom of the market comes before the economy bottoms out, but I don't think that the economy is going to have, kind of like that full-on recession that a lot of people are worrying about, just because the companies, sort of the major corporations, blue chip companies, are looking a little bit too good for that to happen.
All right, great stuff. We'll have to leave it there. Melissa and Sylvia, have a wonderful weekend. Appreciate the time.